What are multi-asset allocation funds? Hey everyone, welcome back to the channel. In today's video, we are going to talk about multi-asset allocation funds, an investment option that has gained popularity in recent years. If you're looking for a way to diversify your portfolio with one single investment, this might be something worth considering. Let's get started and understand what multi-asset allocation funds are all about. What are multi-asset allocation funds? Multi-asset allocation funds are mutual funds that invest in a mix of different asset classes. These funds combine multiple types of investments such as equities, debts, and commodities like gold into one fund. The idea behind these funds is to offer you a diversified investment solution which can help to balance risk and return over the long term. The key thing here is diversification. By spreading your investment across various asset classes, the risk of any single investment affecting your entire portfolio is reduced. SEBI guidelines for multi-asset allocation funds. Now, you might be wondering what makes a fund a multi-asset allocation fund. According to SEBI guidelines, these funds must invest in at least 3 different asset classes, and importantly, the fund must allocate at least 10% of its assets in each of these asset classes. This ensures that the fund is truly diversified and not overly reliant on one particular asset type. So, for example, if the fund is invested in 3 asset classes, equities, bonds, and commodities, the fund manager is required to allocate at least 10% of the fund's asset to each of these categories. This is a rule set by SEBI to ensure that the fund maintains diversity and doesn't over-concentrate in one area. How do multi-asset allocation funds work? When you invest in a multi-asset allocation fund, the fund manager is responsible for deciding how to split the money between the different asset classes. These decisions are often made based on market conditions, economic trends, and the fund's investment strategy. For example, if the market is performing well, the fund may have a higher allocation to equities. On the other hand, if there is a market uncertainty, the manager may choose to allocate more to relatively stable asset classes like bonds or gold. This flexibility allows the fund manager to adapt to changing market conditions and potentially reduce the overall risk in the fund. Benefits of multi-asset allocation funds. Diversification. As mentioned, diversification helps spread risk across different assets, reducing the impact of a downturn in any single asset class. Simplified investment. Instead of buying individual funds or assets for stocks, bonds, or commodities separately, multi-asset allocation funds allow you to invest in all of them through a single fund. Professional management. These funds are managed by professional fund managers who actively monitor the market and adjust the allocation based on the market conditions. Things to consider. While multi-asset allocation funds offer diversification, it's important to remember that there are still risks involved. The performance of the fund depends on the market conditions for the different asset classes it invests in. It's also important to keep in mind that these funds might come with higher fees due to the active management and the complexity of managing multiple assets. In summary, multi-asset allocation funds can be a suitable option for investors looking for diversified exposure to different asset classes with a single fund. However, as with any investment, it's important to do your own research and understand the risks involved. Make sure to consult with a financial advisor to ensure that this type of fund fits your financial goals and risk tolerance. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investment insights. Thanks for watching, and I'll see you in the next video. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.